So it's not just the stock market in and of itself, it's really the overall change in financial conditions and what those changes in financial conditions mean, both because of what market expectations are and for credit availability. So it's not just the stock market in itself, it's got to be sort of the whole set of things in the financial markets.
And those things outside of the stock market, Randy, are really not flaring up as much as you might think would get the Fed's attention in any big way?
So at least not right now. So you're not seeing risk spreads blow out. You're not seeing dislocations in the ability to trade bonds or even junk debt. So areas where there might be a little bit less liquidity. So if those markets sort of freeze up, if commercial paper markets freeze up, if risk spreads blow out, that's something that the Fed is going to be much more sensitive to than just movements in the stock market, which of course move up and down a lot.
So Fisher raised another interesting point, which is he said he has full faith in this Fed to ignore the president, but did raise a risk that the Fed could move to show that they are not reacting to the president, meaning they could keep raising rates or even go faster just to show and assert their independence. Is that a risk?
I don't think that's very likely. I think Jay Powell and the others, almost all of whom have been nominated and appointed by President Trump, are people who are going to do what they're going to do anyway. I think there's a long tradition of Fed chairs ignoring what politicians say, and I think this is going to be the same thing here. I don't think they're going to try to prove a point by raising rates more than they otherwise would. I mean, why would they? If they really thought interest rates should be 2.5% and they go to 3%, that risks an economic downturn, which they don't want.
If we assume, as Fed officials and the markets do, that there is another rate hike in December, Randy, and then from there on, it seems as if there are these two parallel thought processes. One is they want to get to neutral, whatever the neutral rate is, and perhaps a little beyond that to forestall inflation. On the other hand, Chairman Powell has referred very admirably to Chairman Greenspan's forbearance in the late 90s, not raising rates as much as the model said they should because, in fact, it did not cause inflation. So where are we tracking, do you think, into 2019 in terms of the Fed path?
I think that's exactly the question. That's precisely what the Fed's struggling with. And you could see that in the minutes that just came out, that there's some people who think that the reforms that have occurred, both regulatory reforms and tax reforms, are going to lead to a boost in productivity. And Greenspan famously did not raise rates in the face of productivity increases, and he foresaw those more than than others did. And that's the debate now. Is there a big productivity boost coming or not? And I don't think that's been worked out in the minds of most of the decision makers yet.